Thank you for joining us on our webinar with Manulife on the bond market. My name is Jeff Hunter, and I'm Associate Portfolio Manager with the Townsend, Samani, and Hunter Group at CANACCORD GENUITY. Also on the line are our Senior Investment Advisors, Dave Townsend and Raheem Samani. Today's call may contain some forward-looking statements and is being recorded, so make sure to check your email in the coming days for replay information. Today we are joined by Darcy Hutchinson and Macan, who is the Chief Investment Strategist at Manulife Asset Management. Guys, thanks for taking the time and sharing your thoughts today. Macan, can you give us a little bit more about your background and what you do with Manulife?
Yeah, sure. So thank you everyone for joining us on the call. In a nutshell, basically, I'm the co-chief investment strategist at Manulife, and I wake up every morning trying to make sense of the chaos that is always around us. It makes no difference today than what it was a year ago, 5 years ago, 10 years ago. Based on our research, what we will do is we will recommend to advisors like Jeff where we think the best opportunities are, from whether it's an equity perspective or a bond perspective. In a nutshell, we're trying to give advisors the best information so they can make the best decisions for their end clients, like yourself. So maybe I will get started. I'm going to share my screen because I'm a very visual person. Where are you? Tell me when you see.
It's up there now.
Okay, so before we get started, and given that this conversation is going to be focused on bonds, we need to get one thing out in how bond prices work. Because if we do not understand that, then I'm going to be speaking above everyone's head for the next 15 minutes. In a nutshell, all you need to really know is the price of the bond has an opposite effect to what interest rates are doing. So typically, if interest rates are coming down, bond prices are going up. And the exact opposite. And think about the last couple of years. As interest rates have gone up, what have your bonds done? They've gone down. So that's the premise that we're going to start with. And everything else will build on top of that. Now, when we talk about the bond opportunity moving forward, we need to have an idea or understanding of the economic environment around us. So in the financial medium, we've given these probably very confusing statements: soft landing, hard landing, or no landing. All of these basically mean is, what are the odds of a recession in 2023, for whether it's in Canada, US, or global? And the reason we're trying to understand that before we have an idea of what bonds can do is, I ask you, if we're going into a recession in Canada, is this Canadian government or the central bank, are they going to raise interest rates or are they going to decrease interest rates? So think about it. In an economic environment, the economy is slowing down, people are not borrowing, they're not investing, they're not buying things. What does a central bank want to do? They want to stimulate the economy. So what do? They cut interest rates. So as interest rates are cut, those bond prices will go up. So that's why we pay such close attention to the economic environment around us, not only for stocks, but also for bonds. Actually, one can argue it's even more important for bonds. So when we look at the global economy, you can look at it through various lenses. We're looking at it through the health of manufacturing in each one of these countries on the left-hand side. You may say, well, Macan, why are we paying attention to manufacturing? Because manufacturing has a very big role in interest rates, inflation, for markets, so on and so forth. And what this is I'm not going to go into the details. All you really need to know and understand is green is good, yellow is neutral, and red is bad. The far left-hand side is September of 2021, so 2 years ago. The far right-hand side is September of this year, September 2023. Lots of red, lots of yellow, a bit of green sprinkled in there. But when I take a look at this, do I think to myself, okay, we're going to avoid a recession completely? No. From my point of view, there's weakness. I think the odds of a recession have actually just increased throughout the year. Now, many were, and I'm getting into the weeds here, but in a nutshell, many people were thinking that we'd already be in a recession by the summer. that's been delayed. We don't think it's been avoided. We think it's been delayed. There's typical signs of a recession too. Some of them happen before, some of them happen during, some of them happen after the fact. Those after the fact ones are lagging, those ones on the right-hand side. So we all pay attention to unemployment, right? People losing their jobs. But the reality is once that is actually really bad, we're already in a recession. It can't give us clues in terms of what to expect. That's why we pay attention to those ones on the left-hand side, those leading indicators. These typically flash yellow and red prior to the recession. And right now, many of these are flashing yellow and red. Some big ones also flashing red. So for us, we don't think we've avoided a recession. It just so happens we just think it's been delayed. Now, why has it been delayed? It comes to us, consumers. So in developed markets like Canada, US, and Europe, consumption makes up almost 2/3 of our economy. So we matter what we spend. And what we're looking at here is savings rates in the US. The same dynamic applies to Canada, going back to the 50s. And you see on the far right-hand side, that spike during COVID 2020. So we were Americans were saving almost 25% of their income. Why? In Canada, the same theme again. We were being supported. Subsidies. Interest rates were low. And also, for lack of a better word, we were doing our lives through this, virtual, right? We couldn't leave maybe Alberta's a bad example, but even in Alberta, we were locked in our homes. We were just locked in our homes longer in Ontario, but we were stuck in our homes, kind of forced savings. Outside of Amazon, we really couldn't go out, trips, restaurants, and spend money. That's why our savings rates went up. So the past couple of years, what has happened? Inflation has gone up. The cost of living has just increased for everyone. Now, what have we done to really support it? So one, we've been using our savings rates. Actually, let me go back to this. So you see the spike up. Now you see that savings rates over the past couple of years has come down. Why? With a higher cost of living, we've had to use our savings rates to cushion it. Two, we've been using plastic. Credit cards. This is Canadian credit card debt levels today. This is as of October 11th. Look at that spike. We are at multi-decade high in terms of credit card debt levels. The same applies in the US. They're at multi-decades high in terms of that. So yes, the cost of living has gone up, but a lot of us have been able to weather the storm through our savings rates and by using plastic. Now, fast forward to today, our savings rates have been depleted. There's only so much more we can put on our plastic. What is going to be that driver of growth moving forward? So that's why we think, economies remain vulnerable to a recession in the near term. It's likely to be a mild recession because employment remains strong, but there's going to be a recession, we believe, nonetheless. Now let's talk about bonds, because this has been the topic of conversation over the past couple of years, and deservingly so. I asked you, why do you invest in bonds? There's really two reasons. Reason number one is income. Reason number two is downside protection for our investment portfolio. So many of you on the call, the vast majority of investors across the world have a balanced approach to investing. So they'll have some stocks, they'll have some bonds. Why do we have both? One reason for the bonds, I'm going to put the income aside, is when stocks sell off. Why do stocks sell off? Stocks sell off for a whole host of reasons, but ultimately what's the primary reason for it is fears of a recession. So think about companies. If there's a recession, are they going to have higher profits or lower profits? They're going to have lower profits. So stocks sell off. So if stocks are selling off because the economic environment may be weaker, then what are governments going to do? Are they going to raise interest rates or are they going to cut interest rates? They're, of course, going to cut interest rates. So as they cut those interest rates, or the expectation of cutting interest rates, those bond prices go up. And that has been the dynamic between equities and bonds over the last multiple decades. When my stocks sell off because of fear of economic growth, my bonds are rallying because we're going to be cutting those interest rates. Then COVID. a once in a generational type of event that led to generational types of policy, but one was inflation. Inflation we've experienced over the past couple of years that we have not seen in really decades. Let me say it this way, if COVID did not exist, inflation would have continued to be at 2%. Why did inflation go up? Is because we pumped the system full of money. So basically, if there was $1 chasing my iPhone prior to COVID, because of government programs, just money sloshing in the system, that $1 turned into what? $5 chasing us. So is my phone going to be worth $1 or is it going to be worth more because there's $5 chasing it? It's going to be worth more. So inflation happened, and central banks, one of their jobs is to maintain a healthy, stable level of inflation. And how they do that is they've been raising interest rates over the past couple of years to combat that inflation problem, which we have seen success over the past really year to see inflation come down. Now the question becomes is when, if we get a correction or if we get a slowdown, are central banks going to be raising interest rates or are they going to be cutting interest rates? Our view is cutting. So let's go into the two reasons we own bonds. Reason number one is income. We are looking at various income levels or income provided by bonds, very different types of bonds. The green, so let me see, okay, let's look at the far left. You know what? Let's look at the far right. Canadian credit. What is that? Canadian credit is just a very complicated way of saying a corporations issuing bonds. So Apple's a good example. They have their stock. They also issue bonds. The same can be said about Loblaws, Rogers, so on and so forth. But these are high quality companies. So at the beginning of 2022, those bonds in average were paying me only 2%. Really nothing. Fast forward to today, as of the end of September, they're paying me close to 6% in a coupon. So we have not seen yields this attractive in decades when it comes to the bond opportunity. I want to say that again. High quality Canadian company bonds on average are paying me close to 6% today. So the income opportunity is something that we have not seen in really decades. And what about the price appreciation? Because there's two parts to the bond, right? One is you can get income from it. The other one, just like a stock, you can make price. Like your price can go up and down for bonds. But when it comes to bonds, all bonds expire at 100. That's just, it is what it is. Now it can move around that 100, but it will expire at 100. That is a certainty, unless you default, but that's a very low, like less than 1%. Look at the far right-hand side. When you look at the average price for US high quality bonds, it is close to, it's $88. It's basically 88 cents on the dollar, or $88 out of 100. What did I just say? These all mature at 100, or they expire at 100. So that's the price appreciation opportunity for bonds that GICs do not give you. So the discussion today is GICs versus bonds. My first response to that is, if you have a less than a 1-year time horizon, invest in the GIC. It is a guaranteed return. But many, what I find, not those on the call, but some advisors are now looking at GICs as a replacement for bonds in one's portfolio. And what I, not fear, but I think what that is, and we all do this as investors, we're chasing returns. And very rarely, Brad Paisley has a quote. I had no idea who Brad Paisley was, so clearly I'm not a country music fan, but the quote is remarkable nonetheless. And it's something to the effect of, if you make the mistake of looking back too much, you aren't focused on the road ahead of you. So for those looking at GICs versus bonds, I think we're looking at the past and we're assuming that's going to happen moving forward. And history suggests that that's not likely going to be the case. But if you have a longer time horizon than a year, the bonds still hold their value. So let's look at it this way. GICs are paying me, let's just say 5-6%. High quality bonds are paying me 5-6%. So that's a wash. But what I'm leaving on the table when I invest in GICs is this appreciation in bond prices. And then I always say to individuals that push back, say, I'm going to invest in GICs over bonds, is my question is how long have you been investing? The answer is usually 10, 20 years. And I say, well, why wasn't your portfolio stocks and GICs? Why? Is Canada is a good example. 80% of the time, bonds have done better than GICs. And that return is not immaterial. It can be between 2.5% per year up to 5%. So that's why we invest in bonds. It's just that we had COVID, which was a once in a generational type of event that led to unprecedented amounts of money in the system, that led to inflation levels we have not seen in decades. And it threw it out of whack. The question you have to ask yourself as a bond investor, the question I ask myself as a bond investor is, are we in a new environment? And what I mean by that is, let's say Canada goes through a recession. Are we in a new environment where the Bank of Canada is going to say, you know, the hell with them, we're going to raise interest rates? It just does not work that way. You know what that's going to lead to? Even a more severe recession, and then they're really going to have to cut interest rates. So I don't think that paradigm has shifted. And then the other fair question is, well, maybe inflation is going to be different moving forward. And I think it will be different, but it's just going to be higher from a lower base. Why was inflation averaging around 2% before COVID? Demographics, technology, globalization to a certain degree. Those three factors haven't changed really today. If anything, we've got older, right? And we know as we age, we spend less, so there's less money sloshing in the system. And what have we done as society, as individuals, I point to myself, over the past couple of years? We've added to our debt levels. And debt by nature is deflationary. It's not inflationary. I'm a good example. My wife and I were dumb enough to buy a house during COVID. Several years ago, we have a healthy mortgage. Now, as interest rates have gone up and I've been cursing the Bank of Canada, what do my wife and I do? So if every $1 we have to spend, we might have 90 cents to spend now because the good people at the bank are taking our interest. But that's 10 less cents in the system sloshing around, less odds of inflation. So I believe that inflation hasn't changed its long-term trend. Are we going back to 2% that it was before? No, because despite a lot of things coming down, one area that is likely to keep inflation above what it was historically is wages. Wages are sticky, wages are increasing. Look at all the disputes from unions. That's going to have an impact. So are we going to be at 2%? Maybe not, but 3%. Are we going to be at 9%, 8%, 7%, 6%? No. So our view is, as we move forward for bonds, looking at the opportunity moving forward, if the odds of a recession have increased, then not only am I getting my income, but I'm likely to get price appreciation. And the thing with where yields are today, we don't even need a recession really to have a bond opportunity. You can have interest rates fall by 1%, which is going to levels where we were at 3-4 months ago. So it's not that long off, and you get that price appreciation too. So when we look at the bond opportunity, I think in a nutshell, if I could really put it in a couple sentences, is we think the global economy continues to slow. We think that the odds of a recession have not been removed. They remain the same. It just so happens it's been delayed because of the health of the consumer. Challenge we see now is, what can the consumer rely on to continue purchasing? We don't think there's much left there. As a result, if and when we get not even a recession, let's just say a slowdown, central banks, Bank of Canada is going to be much more likely to start cutting. And when you start cutting, your interest rates go down, but my bond prices go up. And we'll go back to the experience of how we felt about bonds and the importance of them in our asset allocation moving forward. So maybe I'll stop there, Jeff, and pass it back to you. If there's any questions about this or anything in general, we could talk about anything. I'd be more than happy to discuss.
Yeah, so for those in the audience, there is a Q&A button in the bottom. If you just type in anything you want, we can ask on your behalf. First kind of just more of a technical question. Can you talk about the differences in in how prices react between bonds that are government, corporates. I don't want to go too much into floating and the sort, but just a simple government bond, a simple corporate bond, and even some preferred shares, and how those react in different environments.
Yeah, so ultimately, I asked those on the call, if you had to give your dollar away to whether it was a government, whether it was a corporation that has a good balance sheet, like they're good business, versus a bad balance sheet, versus a bad company, where would you demand more of a yield from? For me, I think the Bank of Canada is, you know, a safer place to invest in given its backdrop. So if I was giving money to the Bank of Canada or to Canada, I'd say, you know what, I want 1% back in interest. Now, if I invest in a good quality company, it's not as sound as the government. So I might ask them to pay me 2%. And then you have a company that, you know what, it's a maybe newer, more riskier. May I'll say, you know what, I'm less confident with you, so I want 3%. So that's how the yields work. Now think about it during times of stress. During times of stress, where do you want to invest your money? In safety or in something that is maybe more riskier? Of course it's safe. So during times of recessions, what bonds typically do well? Government bonds do really well. Good quality companies do very well, those bonds. Now, when you come out of a recession, what do you want to invest in? You want to invest in stuff that is levered or levered to the economic output. So when you come out of it, you actually are better off being in those riskier type of companies because they're probably less likely to experience a bankruptcy in a strong economic environment. So if you believe that we're going to go through a slowdown from a bond perspective, history would suggest, the data is out there. I'm not going to bore you with the exact numbers, but the government bonds do really well, then followed by high quality company bonds. And then, of course, at the bottom of that, we call it high yield, but it's more riskier type of company bonds.
Another thing, a lot of conversation headlines about the inverted yield curve and yield curves in general. I know the US is not nearly as inverted as Canada right now at this point. Can you explain what that means for economic situations, what people's views are going forward? And then just on top of that, if the US Fed, ECB, and Bank of Canada have different economic situations, how will the respective bond prices react?
So let's start with that one because I think that one's easier. I'm just going to focus on US and Canada from this perspective. If we believe the US is likely to experience maybe a mild recession, we think in Canada we're a little bit more vulnerable to a slower slowdown. And it really comes down to, as Canadians, we are much more interest rate sensitive than Americans when it comes to our debt. What is probably not the greatest question for this, but for the rest of us, the biggest debt we have is our houses. The difference is in the US, they have these beautiful things called 30-year fixed mortgages. I know what my mortgage rate's going to be fixed for 30 years in the future. Less interest rate sensitive with interest rates going up. Whereas in Canada, most of us have 5 years and they're variable. So we are much more interest rate sensitive. So I think, and also our economy has become much more reliant on real estate than, let's say, the Americans. So in a slowdown, we think we're going to experience it more. So is the Bank of Canada going to cut more than the US? We think so. So as they cut down faster than the US, they're both going to be cutting, but Canada is going to be cutting faster. And as a result, Canadian bonds probably should be going up higher than, in very generalities, than the US. The inverted yield curve one is going to be very, very complicated to explain. But ultimately, there's various, let's call it ages of bonds, right? So, or time frames of bonds. There's a 2-year bond. There's a 5-year bond. So basically, you're lending money to a corporation or a government for 2 years. expecting interest over those 2 years, or over 5 years, expecting interest for 5 years, so on and so forth. How it works typically is, would you feel more comfortable lending to a company over a shorter period of time or a longer period of time? Longer period, or feel comfortable, shorter period of time, right? Because listen, look at this year or look at the past 5 years as a perfect example. A lot can happen in 5 years. So if a lot can happen in 5 years, I want to be paid for taking on that risk. So that's what happens. So typically the shorter end, this is going to be really hard, but the shorter maturities are typically lower yields than the longer. When you talk about inversion, that's flipped. So what this is saying is, in the short end, it's being controlled by Bank of Canada. And over the longer term, like 10 years, 5 years, what controls or what impacts those rates is people's economic expectation. So what has happened? We've seen interest rates go up dramatically in the short end. So you've seen it's actually just inverting. And what happens if interest rates are going up in the short end? People worry about the future recession. So that's why it's gone down on the 10-year. It's really complicated. I think ultimately what we're trying to say here is based on the bond curve, like based on bonds, whether you're comparing 1 year versus 5 years, the bond market is saying that we are likely to experience a slowdown because of the high rates that we're experiencing today. Going back to the bond opportunity, if that materializes, we're going to have to be cutting that. And as a result, one should expect bond prices to go up.
Thanks for that. Just to go back to the GIC and just talk about the tax differences between some of the bonds that we're seeing and the additional benefits in a non-registered account for bonds versus.
Well, I think you guys are best to explain that to the client than I do.
Simply put, the capital gain is going to be a substantial head or tailwind for your returns, especially if you have OAS, clawback issues, and other parts. Tax consequences matter, and the benefit right now is that a lot of bonds are trading at a discount, and by doing that, you can have some capital gains built into your expected return, so that when you end up seeing what you actually get to take home, the dollar amount can be much greater because of that.
And Jeff, that's a very material point that you made that I think sometimes is lost. That's why all of you on the call have an advisor because of that. So you look at, I know, and clients will say, oh, GIC 6%. They're not even aware of bond income, but let's say they're 1 for 1. Okay, but you're leaving that price appreciation on the table, which is also taxed. It's not how much money you make. Ultimately, we all know this is how much money you get to keep. And from a capital gain perspective, you're not only getting more money, but you'll be able to put more in your pocket as a result of the different tax regimes.
Just while we are talking about bonds, something somewhat related, currencies in times of fear and greed from a Canadian perspective, in particular the US dollar versus Canada.
Yeah, so in times of stress, again, we talked about bonds, right? In terms of who are you willing to not require as much of a yield given safety. Currencies are the same thing. So in times of stress, investors seek those currencies that are stable. And the ones that are stable are the US dollar, Japanese yen, Swiss franc. And look no further than the great financial crisis as that unfolding. The subprime or the great financial crisis started in the US. It was a US problem that spread to the rest of the world. The US dollar was the one that appreciated in that environment. So it just speaks volumes of the trust that you have in the US dollar. Now, when you look at Canadian US dollar, I think at the margin, oil drives it, typically oil and interest rate differentials, which is a difficult way of saying how much can a foreign investor get from placing $1 with the US government or over Canada. And wherever that dollar is higher or returns higher, they're going to probably invest in that area. So for us, I think we're in this middling of the ground. Maybe there's more downside in the near term for CAD. I think over the next three months, right? One reason being is I think interest rates get cut faster in Canada than the US. That alone will make the US investment opportunity more attractive than Canada. But that sets up Canada really well for next year, right? Because I tell clients, what we know about recessions is they happen. They don't happen that often, but when they happen, and they're short in periods. What we also know from each recession is there's an expansion that happens afterwards that's much longer and much stronger. The Canadian dollar does really well in that environment. That's probably a next year's story, but I think in the near term, there might be more vulnerabilities with Canadian dollar versus the US dollar, but not that material right now.
Elections, big one coming up in the US next year. Thoughts on that? How will they typically affect markets? Longer term, shorter term? Just
So,
generalities more so.
In a nutshell, it doesn't matter whether it's geopolitics, whether it's politics. It may have some impact in a very, very short period of time, but it very, very rarely has an impact in the medium to long term. We asked ourselves, is this a disruptive event or a destructive event? If it's destructive, then it will have an impact, but very rarely are these geopolitical or political events destructive to the broader global. COVID was destructive, right? And we saw the impacts. But think back to the unfortunate invasion of Ukraine from Russia, right? On February 24th. A couple days, market sold off. 2 weeks later, we were back where we were. And it's unfortunate, like taking off our humanitarian hat and putting on a very rational investment hat with what's unfolding in Israel right now may have an impact in the short term, but very unlikely to have an impact medium and long term. And even look at what's happening over the past couple of days. You would have thought that this happened, oil prices would shoot through the roof. They've actually come down. So when it comes to politics, geopolitics, it doesn't matter. What matters are the fundamentals. It's the economy and the businesses, because ultimately that's what we're investing in. We're investing in companies.
Just a generic kind of situation. We have much higher yields right now versus a couple of years ago at very low yields. How would be, say, another 4% or 5% move higher in rates should it happen, if it did happen? How would the prices be affected in comparison to the move we had from the bottom? From 0 to 5.
Well, now it gets into duration, convexity, and all that. But
general, I'm not going to get convexity to be explained on here.
Yeah, so I think generally, I think if yields were to go 4% from these levels, it's just another, you're going to get the same type of aspect from your bonds. Like, I actually think that it will be even worse in the sense that how many of us can cushion another 4% in interest rates increasing? Like, that would be like a severe recession. But I think the way I would look at that is, what's the odds of that happening, right? It's extremely, extremely low unless inflation shoots up through the roof based on something. We have seen inflation trend down from peaks that we saw, like in that 8 to 9% range, to where we are today at 3 and 4. The things that led to that type of inflation, which was money sloshing around, go through the list. They've all come back down, with the exception of oil prices. So another 4% increase, yeah, bonds would get their heads handed to them again. There's no doubt. But I think
what about the magnitude? Would it be a similar experience in terms of prices, or with yields already at 5% on governments, keeping duration?
I think from a total return perspective, you're more insulated, right? So look at a couple of years ago when you had that. Let's just look in 4% increments, okay? So the first 4% increment, let's say we saw yields were at basically 1%. So I didn't have that income, because we're looking at it from a price appreciation perspective and my income. I get two things. So 2-3 years ago, my income was nothing, it was 1%. And then when yields went up, my bond prices went up or went down, excuse me. Starting today, my yield's at 6%. So I have a lot of cushion built in there in the event that yields increase by 4%. So I get what you're saying with your question is the magnitude on your bonds moving forward is going to be less because I have a cushion now of 6% to help if interest rates were to increase for that. So that's a big difference between now and 3 years ago. And also the risks of when an investor might look at the past and extrapolate that forward, because my starting point today is much better than my starting point 3 years ago.
Raheem, Dave, any comments, questions?
Yeah, here, Raheem here. I am Macan. Great presentation, very simple. Let's go on the offensive here. Where should investors be positioned here? Because you know what, it's a bull market somewhere. So if it's not a bull market in equities right now, there has to be a bull market in fixed income or credit. And the presentation is shaping up like that we are looking at an opportunity here. So first question is through your lens, advising some of the biggest investors in Canada, institutions, family offices, our clients, how should we be positioned for the next 12 to 18 months? And on the second note, how do we reposition current investments potentially so that near-term returns are one thing, but longer-term returns are another? So if I rephrase it, if I was to be a credit investor or a bond investor right now, where do I pick up low-hanging returns right now in one part of my portfolio? And how am I positioned so that over the next 12 to 18 months, if we enter a slowdown, number one, number two, on the back end of a currency devaluation in Canada, but then potentially a growth market throughout next year as interest rates get cut. So it's a two-pronged question, but ultimately what I'm asking is, if I had to allocate capital today for the next 6 months and for tomorrow for the next 18 months, what are some opportunities that you're seeing out there in credit?
So I think over the next 6 months, you want to be investing in high quality government bonds and high quality company bonds, in the sense that if we get a slowdown, those bonds have an income to support it. And again, when they start cutting those rates, those prices are going to go up. So I think in the short term, you're positioned well in government bonds and in corporate bonds. And let's say even if you don't get a recession, let's say we just skirt along, you're getting 6%. So it's an interesting opportunity set. And I think afterwards is we call it high yield bonds, let's say. And what high yield bonds are is just companies that are riskier. So they give you a higher yield. So giving the example, those high quality Canadian bonds are yielding you 6%. High yield bonds are yielding you 9-10%. So you might say, well, let's invest in those high yield bonds today. If we get a recession, those bonds are going to lose their bond prices are going to go down because people are going to be afraid that they might go bankrupt, so on and so forth. But that's the opportunity at some point, I think in the next 3 to 6 months, is you make your money in government bonds and high quality Canadian bonds. Then you take those proceeds and then you don't put all of it, obviously, in those higher riskier ones, but then recycle some of those proceeds into those high yield bonds because they do really well for the next phase of the expansion.
Awesome. And would you follow the narrative that all of the capital that's been going into GICs, government treasuries, billions, trillions over the last couple of years, as a return profile has been getting stronger, that once the credit markets and the bond markets find stability, and the real word here is confidence, that you're going to see massive inflows in credit? Because as central bankers start to cut as a defensive posture, that credit markets are going to come on very, very strong because they're really ripe for returns.
100%. Like, I think we as investors, we're all guilty of this because we're emotional and we're human, and we have a tendency of taking what's happened in the past, whether good or bad, and extrapolating that forward and saying, okay, this is going to happen continuing forward. And the investors that really make money are the ones that can act opposite of that. We call it contrarian in those periods. There may be a couple months where it's hurtful to be in it, right? But you're positioning you might, leave I'm throwing random percents out there, 3% on the table. But what's more important is making sure I'm positioned for the next market. Like, you're never going to time things. The timing's impossible to do, but it's being able to position yourself, and there might be some short-term pain, but position yourself for the longer bull market that more than compensates you for getting in maybe a little bit too early. So I think that's a big one. And yeah, money's going to flow. Like, once it flows, and we also know this, the data all suggests it is the money comes in after the fact. They're always chasing returns, and you might get some returns at the margin, but it's those ones that, had a conviction at the beginning. Also, you don't have to put all your money in at once. You can ebb and flow. We call it dollar cost average. Put in a little bit now, a little bit next month, a little bit next month. If you get a big drop, then you put the rest of it in. So I completely agree with that. I think once this narrative starts unfolding, because you are right, Raheem, there's a massive amount of money on the sidelines because people are scared. We always see this. When people are scared, they take money out, they keep it on the sidelines, and they're always, always, always slow to get back in because the rally happens and they're like, oh, no, I'm going to wait for it to pull back and get back in. Because we're always trying to save money. We're all at the end of the day, a little bit, we want to get the best opportunity, right? But what I've seen is these bull markets, and my colleague Kevin says this quote, and it's so right, is bull markets do a wonderful job of not letting us back in because we get in our own heads. And then by the time we look back, we're like, oh, shoot, I just missed a massive bull market.
Yeah, I agree with that. And, one narrative that I point a lot of people to is, there's value investing based on portfolio strategies. There's value investing based on equity markets. There's value investing based on following strategists. And then there's value investing based on opportunity. And this is the opportunity set, I think, that creates value investing for investors who are looking at the distortion in the market right now. And the thing is we're so sensitive to the markets, but sometimes we just don't turn over enough leaves. And right now, I think we're seeing a huge value opportunity in credit markets, not even taking on the equity risks that equities provide. So you're at the back end of the balance sheet. That's usually the safest. Now all you have to do is figure out where to go. And that's where Manulife and our team can help with that. So I really appreciate your guys' time today. And I'll turn it back to you, Jeff.
Dave just had a quick question. He's having some audio issues. If there is prolonged geopolitics events, and it's more about the attractiveness of the yields in the US, would it draw further capital into North America or developed markets not related to geopolitical events at the time? Or is that something that's just, there's going to be too many arbitrage opportunities between currencies and yields to really?
So what the question is if, let's say, having that this conflict in between Israel and Palestine becomes a much bigger, let's say, satellite, bringing in Iran or Hezbollah and all that. Yeah, the bonds is a tough, because bonds are a function of the economic environment, right? So yeah, it may impact it because oil prices might shoot through the roof, sure. But I think the bigger one with that would be currencies. It's the flight to safety with that. So the US dollar would definitely benefit from that. But the bonds are ultimately, if oil prices go to $200, then that's going to put the economy in a recession. But that in itself will make it very short-lived, right? Like at 200, they're cutting interest rates to zero. And actually, as weird as it sounds, in that environment, bonds do even better because because how much price appreciation you get is based, let's say I'm just using round numbers, 5. If you go from 5 to 3%, the return's going to be less than 5 to 0, because the magnitude of the drop is obviously much bigger from 5 to 0. So in an environment where oil goes to 200 and the recession is going to be extremely, extremely hard, as weird as it might sound, your bonds will actually act like a stock. Equities in that environment, like, you're going to be up massively in that environment. Let's just hope that doesn't unfold that way.
Perfect. Well, hey, I really appreciate your time.
My pleasure.
Thanks so much for everything you do and all your send outs and the sort. We really appreciate them. And for everyone else there, thanks for sharing your lunch hour with us. And if you have any questions, feel free to reach out to Dave, Raheem, or myself. More than happy to help. Thanks again, guys.
Take care, everyone. Have a good day.